Hi, this is Jeff Baxter. I'm a M&A advisor with MidStreet Mergers and Acquisitions in Raleigh. And in this video, we're going to talk about sellers' discretionary earnings and how it relates to the value of a business. So sellers' discretionary earnings is a measure of profit, similar to EBITDA or cash flow, that measures how much money the owner takes home at the end of the year when you add back certain items that come out of the profit that might not necessarily be leaving the owner's bank account. So the idea is that you're going to take the profit of the business and add back certain things, for instance, depreciation, interest, and the owner's salary in most cases, and that's going to give you a number that represents how much money someone, if they were to come in and buy the business, would earn owning and operating the business themselves. So this roughly translates to, if I buy the business, what's the total amount of money that I'll get in my pocket before tax? That's kind of the objective that we're trying to find. So there's a couple different types of items that we're going to add back. One of them is tax-related items like depreciation and amortization. So these are your non-cash expenses that you're not actually paying, but show up on the profit and loss or on your tax return to reduce your taxable income. We're also going to add back financing-related expenses like interest, because the idea is that a new owner will have their own capital stack, they'll have their own loans. So we want to be able to compare apples to apples between businesses and between owners, irrespective of where the money comes from for the business. And we're also going to add back discretionary items like the owner's salary and family trips. So let me move myself out of the way here, and we'll take a look at this example. So the concept of SDE works like this. You'll have your net income, so this could be from a tax return or from a P&L. We prefer to use tax returns when looking at businesses we're valuing internally. And you're going to take that net income and add back depreciation, interest, owner's salary, discretionary benefits. This might be things like if they lease their personal vehicle through the business, or if they have a personal cell phone, family vacations, personal meals, date nights, that type of stuff. And when you add all that up, you'll get the seller's discretionary earnings. So this is a quick explanation of each of those add backs, just to give you an idea of why, because these are the most common ones, why we're making that add back. So owner's salary. The goal of SDE is to find out how much someone who owns the business would get. So if you owned the business and you were operating it for the whole year, at the end of the year you would have a certain amount of profit on your tax return. Well, that profit is after you've paid yourself, but you already received that salary, so it's the same. That money's fungible. So because of that, we add it back so you see the total amount of the profit plus the owner's salary. And we'll talk about later in the video more situations where you might not add back the salary. But in most situations, if the owner's working full-time in the business, then you're going to add back their salary. We add back depreciation because it's a non-cash expense and it wasn't actual money spent. CapEx we'll talk about later in the video. It can be a little confusing. Sometimes you'll add it back, sometimes you won't. But in most cases, or pretty much every case, all the depreciation will be added back. Same thing with interest. It's typical for a new owner. Maybe they're getting an SBA loan, in which case they're going to have a lot of interest relative to the old owner. Their vehicles might or might not be financed. They might have equipment loans that are going to be paid off. So we don't want to include the seller's interest in that SDE number when we're comparing between businesses. And then optional expenses, when the owner chooses to spend money on things that don't add to the revenue, like charity, it's a good thing to do, but it's not necessarily indicative of the business's performance, so we want to take that out. And then the last thing is where SDE is differentiated from things like cash flow or EBITDA, is we're going to add back the seller's discretionary items. So I listed out a couple things there: cell phones, vacations, boats, leased cars, so many other things. We've seen so many items. I mean, everybody knows that owners write off things through the business that might not necessarily relate to the operations. So we're going to try to identify what that is. Now, I will say, depending on the size of the business, you probably want to establish some minimum, because you don't want to be adding back, $150. But there's also probably a maximum that you're going to want to consider as well. Now, there are owners who will add back massive sums. When you're calculating SDE for the purposes of evaluation, it's probably best to add back those larger expenses, but we'll talk about later in later videos when we're actually establishing a value, how when an owner chooses to do that, it might actually impair the value of the business. So touching on that last point again, personal expenses, or actually, switching gears to one-time adjustments. So there's one last type of adjustment that we have to make, and that is things that only occur one time or might not be in the normal course of business. So put an example here that say your business makes $500,000 a year, every year for 5 years, and you've had no issues collecting debt from customers. Customers have paid you on time. Then one of your customers goes bankrupt. It's the first time it's happened to you, and you had $100,000 in outstanding receivables from them that you wrote off, and they showed up on your tax return. As a valuation specialist, I would look at that and say, that was really a one-time event. You haven't had that in so many years. It's the first time in your company's history that you've lost so much money. Normally you lose $5,000 to $10,000 a year, but this one year you lost $100,000. That shouldn't impair the SDE, so what we do is add that back and consider that to be a one-time thing, a one-time occurrence that isn't going to continue to happen. Now, if you were to have $50,000 a year, and then one year it was $65,000, we wouldn't necessarily add that back because that would be considered within a reasonable margin of error that could happen again. So this is where discretion comes in, and SDE's definition becomes a little bit subjective, depending on who's doing it. So that gives you a good idea of the basics of SDE. If you want to learn more in a written format, or you want to learn more with just examples, we have a great blog on the MidStreet website, midstreet.com/SDE, and that'll give you some more learning there. But for now, we can hop in to this recast example, which is from a valuation that I did a couple years ago, and I've pulled out all the identifying information for the company. So we can hop in and take a look at the adjustments that were made and see what we can learn about this business's discretionary earnings. And I'll also try to give points for other businesses. I can only pull up so many valuations, but there are hundreds of add backs, hundreds of cases, and some of it is, we'll talk about things in the office. There's gray areas. So going to get started here and jump right in. All right, so this company, it looks like the latest year that we have is 2020. So this information is from the tax return. So this is directly off of their 1120S input into our valuation format, so it's a little bit easier to look at. So what you're seeing here is a P&L or an income statement where we've put it into 3 columns. So this first column here is exactly as it was reflected in the tax return. The middle column is the add back that we're making, and then the adjustment column is a new P&L that's recast, or what's referred to as a recast P&L. So what you'll see at the bottom here is this is the net profit or the taxable income that's shown on the tax return, and this is the SDE after the adjustments. So you'll see we went from $539,000 in total expenses to $238,000. So going down the line here, revenue, we didn't make any adjustments to revenue. It's very uncommon. Typically it would be things like if you had a one big time sale of some kind. Very rarely see that though. No adjustment to returns and allowances, no other income, so we didn't have to adjust it. One thing to note about other income, a lot of the times you'll see the gains on the sale of assets included in other income. Typically pull this out unless it happens every year. For instance, a construction company that is buying and selling equipment every year. If you're buying $100,000 in equipment and you're selling $100,000 in equipment a year, or you're selling 50 and buying 100, then we would want to leave that in because it does happen every year. But if it's every couple years, then we'll tend to take it out and treat it separately. No adjustment to the cost of goods, but the first adjustment is to the officer's salary. So you'll see how this works here. The officer's salary on the tax return was $240,000. Now I know from looking at the tax return for this business that is the one full-time owner-operator. So the business owner, this is their full salary. So you'll see here that we added back the full amount. And then this column this cell is equal to the full amount minus the adjustment. So the new officer salary is 0. So this is we added back their salary, again, because the business owner is going to get to keep this money. So it's a part of the SDE. Taxes and licenses, this amount is the officer's payroll taxes. So you can estimate this by taking 7.5%. It's the company's contribution to the officer's payroll taxes. The reason we add this back is because the only reason the payroll taxes were paid is because the officer or the business owner chose to take the salary. So if they chose not to take the salary, then this just would have been more cash flow. Interest expense we added back for the reasons discussed before in the video. Same thing with depreciation. Pension and profit sharing, this would be the employer match portion of the owner's pension and profit sharing, whatever type of program they have there. This would be a contribution from the business. So if you go down to the notes here, oh no, this is health insurance. Okay, so this this expense is out of the. You can see they're mislabeled here, which is super common. So what would happen is we would have asked, hey, on your tax return, I see you have pension and profit sharing. Can you tell me a little bit about what program that is and a little bit about, or the number that the owner received so that we can add it back. So we know that this is health insurance that went to the owner. So we add that back and you go from 15,000 expense down to 11. And then the employee benefit program is note D. That's the officer's 401k contribution. So this is the company matched portion of the contribution. So the company matched 16,000. That's money that's going to the owner, or benefit that's going to the owner. So we're going to include that in the SDE. And then it looks like there's no other adjustments. So when you sum up the 240,000, the 11, 19, 9, 4, and 16, you end up with that difference here. And so they went from 643,000 to 945,000 in SDE. And what this represents is that net profit plus all of the expenses that the owner received throughout, or all the benefit the owner received from running the business throughout the year. So going down, and you'll see the same things here. A lot of them are repeated. Typically for a business, once you get 1 year, there might be 1 or 2 different between years, like one-time expenses or things, but it tends to be the same year to year. So you'll see here very similar, from 311 to 621, and from 571 to 853. And then we sum that up on one page that shows you the new recast financials. So for the purposes of selling the business, this is the information that would go in the SIM, or confidential information memorandum. That's where we're listing the business for sale. We're giving the potential buyers this document, and this is what they're going to see. So they're going to see that the business produced in benefit to the owner $853,000, then $621,000, then $945,000, and you'll be able to see the margins down here. This is a very profitable business. I don't remember what industry it's in. Typically, you wouldn't see SDE margins this high. Typically, somewhere in the, depending on the industry, the 12 to 22% range is probably about what you'll see. And you typically don't see this big of a jump. So going up to the top here, it's not unusual. There are cases where the business will lose money on the tax return and make a couple $100,000, $500,000, $600,000, $700,000 in SDE. It just depends on how aggressive the owner gets with the add back. So hopefully this video gives you a pretty good idea of what seller's discretionary earnings is and how to calculate it for your business. Going through a couple more line items here, I just want to make sure that I cover some things, some questions that might come up. So auto expense, if you rent your, or if you lease your vehicle through the business and you don't use it for personal, or you have a second car, a lot of the times we'll also see the spouse's car is leased through the business. We'll want to add that back. Now, one thing to be careful of is if the car is financed, if the vehicle is financed, you don't want to add back those payments, because they're not already included in the income statement. Those are being paid with cash that's below the line, below the net income. So if the vehicle is financed, you can add back the interest, which would be in that full interest amount added back, but you don't want to put any principal amounts on here. You only want to add back money that's already on the income statement, that's already been expensed. So let's see here. Rent is another common adjustment. If you own the property that the business is in, or if the business owner owns it in a different corporation and they're paying themselves rent, you want to make sure that the rent is market rate and has been adjusted to the market rate. So if the owner owns it and the mortgage is $5,000 a month, and they're paying themselves $5,000 a month into a separate company to make that payment, or maybe a little bit more, you'll want to do a broker opinion of value or ask the seller what they feel a market value rent is for the building. And then you're going to recast that here by increasing, so you'll make a negative adjustment to raise the rent if they're underpaying. A lot of times they're overpaying, especially if it's a profitable business, so you'll want to reduce the rent down to that level. This is definitely something to watch out for in businesses where the owner owns the real estate, because it can skew the SDE by a lot, by $100,000 plus or minus in some cases. So continuing to go down. In a later video, we'll probably address 263A expenses put on the income statement. For the purposes of this video, we'll just leave it here. This is if you converted your business from a cash to accrual basis, or an accrual to cash basis. I mean, you'll want to, this will be on your income statement, something done by your CPA or done by the business owner's CPA, but we'll just leave it for now. A good example of a one-time expense would be a software setup fee. So if a company implemented a new ERP like Epicor and they charged a huge fee to get started, or a setup fee, consultation for setting up the software, that's something that you'll want to put here because it's going to last for many years. That setup fee is not something they're going to have to pay again. So you'll add that back. Meals often get added back, but you'll see here, this is an example of somewhere where the meal expense was $500. It's probably not worth adding that back because you're going to have to explain it. And if the deal goes SBA, then you're going to have to explain that to the bank. You might have to provide documentation for that. And $500 is not going to make or break the value of the business. So in my opinion, and this is where SDE gets subjective, less add backs is better than more. And you kind of have to set that threshold based on the size of the business for what you feel is material. But in this case, a business doing $1 million in cash flow, I don't feel like a $500 adjustment makes sense. Let's see here, anything else? Telephone, another one. In this case, it's $6,500. So, reasonably speaking, a business telephone bill is probably, knowing the industry of the business, is probably around that amount. So you can assume that the seller's cell phone isn't in there. But sometimes you'll see cell phone bills that are tens of thousands of dollars a year for a small business, in which case you probably can assume the owner has some of their personal, their kids or family members' cell phones in there. And for smaller businesses especially, this can be a good add back, so you'll want to check, especially on a MidStreet deal where they have iPads and phones and kids and other family members on there. So hopefully that gives you some other ideas for add backs. If you have any questions about an add back, feel free to leave it down in the comments or shoot me an email, jeffjr@midstreet.com. So jeffjr@midstreet.com. But thank you for watching. In the next video, we're going to cover EBITDA, adjusted EBITDA, and a comparison between sellers' discretionary earnings and EBITDA, and so how you know when to use which one. So thanks again for watching, and look forward to seeing you guys in the next video.